Hi, I'm Al from the Money Study, bringing you another episode in our Take 10 Challenge, number 42. This interesting thing called LICS or LIC, which is effectively a listed investment company. So it's another way to buy our shares. Before we kick off the information, there is our disclaimer: facts and figures, information only. We are not providing you with advice in today's session. So, a listed investment company, that's what a LIC is. So when you invest in a LIC, you buy a LIC, what you're doing is you're actually buying a company, and that company itself goes out and buys companies. So all the company doesn't actually do anything as far as produce things. It doesn't manufacture. It doesn't fly people interstate. It doesn't do mine goods or anything like that. All it literally does is turn around and buys other companies. And so what we're relying on here is the LIC has got an investment team. They go out and do all their research, and they just start to actively manage all the money so that they are buying and selling shares in companies that they believe effectively are going to benefit the value of their company. So obviously the LIC is only as good as the team that they've got in the company that does all the research to see how successful they're going to be in the long run. So all they really are doing is you are effectively buying a company and hoping that the investment team in that company is good at what they do, because they're not going to buy the shares so you didn't have to think about it. So instead of you perhaps buying Commonwealth Bank or, as we say, or ANZ, they got with all their team and all their research, they would know how much of each one. If they got each one, they might only have one out of all the banks, and so it goes on. But in theory, we've now effectively got an investment team working on our behalf. So you buy shares in the one company, but effectively buying many companies. Berkshire Hathaway, which was a huge company in America, which was started by Warren Buffett, who, even those people are not into finance over the years, would probably have heard of his name. Probably one of the most successful, if not the most successful investor in our living time. And he started this company as a very little small thing, but all Berkshire Hathaway does is buy companies. So it's a LIC, and it's probably one of the most well-known LICs in the world. And its value, if we just imagine if we'd bought shares in Berkshire Hathaway when it first started out, we'd probably be having a different lifestyle. So this whole business of a LIC, there's a few little tricks we need to sort of get our head around a bit to understand what this is all about. Now, unlike an exchange-traded fund, which we're going to talk about possibly even tomorrow, then an exchange-traded fund sort of tracks a benchmark, meaning that it's probably trying to perform better than the top 20 companies in Australia or something like that, where it's trying to match the performance of the top 20 companies or something like that. Whereas a LIC manager, what he's trying to do is outperform. He's trying to say, well, okay, just because the top 20 companies are the top 20 companies, does that mean that the top 20 companies are going to make the most amount of money? They go looking for opportunities, and they are saying that, okay, the companies we're going to buy is actually going to outperform the market. Now, whether they do or not, of course, is another story. But that's basically what the difference is, that an exchange-traded fund is going to copy the market, but a LIC is trying to do better than the market. That's the trying, I think, is the operative word there. So the manager in the LIC, they're responsible for setting their objectives, meaning what are they trying to do here? You know, are they really just going to invest in some particular style of shares or so forth? So, you know, are we just going to look at ones that are going to grow bigger, or are they going to chase ones that have got good dividends and so forth? So each one of these LIC companies has a different idea, and I'm going to show you some examples coming up in the next few slides as to how these LICs, even though they've got the same idea of buying companies, they have a different idea of how they go about that. So now LICs are what we call a closed investment. So unlike a managed fund, which again we're going to talk about those in the future, they don't issue more or cancel shares as investors come and go. So literally there's a set number of shares available. So there's a set number, and therefore if you're trying to buy a LIC, you've really effectively got to wait for someone to sell a LIC so that you can buy that particular share. So it's not like new shares are created every time new people come along wanting to buy it, which we'll find out that works with ETFs, but not these LICs. So LICs are pretty much like, like our normal shares. There's a fixed number of shares in a company, and if a new person comes along, that company's just not going to create new shares for them. They actually have to have someone who's prepared to sell. And this is what can really make the market move quickly in a situation if the market's going up. People have got to push the price up and up and up and up before someone's willing to sell it to you, and vice versa. If the market's falling, perhaps they need to drop their price so someone's willing to buy it if the share price is going down. So it certainly can have that style of structure can certainly impact the availability and the liquidity as how much these things are available and what's going on with the share price there. The fees involved with these LICs can vary quite dramatically. So if you're going to do a bit of research on it, you might want to sort of check the fees, because an interesting thing with LICs is that they quite often have what's called a performance fee, meaning that, yes, the value of the company would go up as the value of the shares that they've bought goes up, and vice versa, of course, if the market falls. But if they do their job well, and effectively, the performance is above a certain line in the sand, might be 20% or something like that, better than what they were anticipating, what they were trying to copy, then if they outperform, then the company, the LIC itself, gets to keep the profit. It's not actually it's part of the fee that you are effectively incurred, so you don't get the distribution if they actually do and outperform dramatically. You still get a portion of it, but 20% of it perhaps might be kept inside the company. So that sort of puts so if you look at the situation that if the LIC, say, had 30 companies and they did exceedingly well, then it's not like you just add up the share price of those 30 companies and that's all your money. That's not what the LIC has gone up by, because they'll keep their own. The company itself is keeping that performance fee. So that can have an impact on the valuation of the share price compared to the actual valuation of all the companies they have bought indeed. Okay, so fees are always one of those things in everything we deal with, and with all the bits and pieces we talk about here, we'll be talking about fees, and of course it's always a good idea to understand what sort of costs and things are indeed involved. Now you might hear the other terminology of someone calling it a LIT, which is a listed investment trust. Pretty similar to a LIC in the way that what it does. It's just really the difference between a LIC and a LIT is really comes down to how that particular company is treated for tax perspectives. So in a LIC, which are probably the more common things that people sort of talk about, then all the dividends and the capital gains and so forth are treated like income. And so they'll be paying tax, the LIC will pay the taxes on those earnings. But a LIT, well, they will pay all the net income and all the capital gains to the investor before those taxes have been paid, and therefore the investor then has to be liable to pay the taxes on it. So it's a case of the difference is in how the tax is distributed, who's paying the tax. Is the company paying the tax, or are you paying the tax after you've already received it? So a little bit different, as you can see there, than what we spoke about when we were talking about franking credits and so forth. But, however, some of these LIT investors are indeed eligible. There's other tax discounts, which I won't get into in this session. But so just making sure that before you jump into a LIC or a LIT, you understand what your liability is going to be when tax time indeed comes around. don't want to get caught out thinking, gee, this is what I've just made, only to realise that you've just got to turn around and then start paying extra taxes on it. Some of the big popular LICS that are out there, these are not product recommendations, that's for sure. I'm not suggesting you for one instance you go out and buy these particular companies. These are just the biggest, probably the biggest, most well-known ones. And what I'm trying to do here is just sort of show you that a LIC is not a LIC is not a LIC. You know, that they can indeed be totally different based on the company that's running them as to what they're trying to achieve. Look, the Australian Foundation Investment Company, AFI, yeah, probably the biggest LIC, and I didn't check that, but I'm pretty sure it's by far the biggest one out there. It's been around, since 1928, so it's been around a long time, which gives you some sort of security that these guys, you wouldn't be buying into these things if they wouldn't be still around if people weren't still buying into them. Put it that way. But these guys have got a long-term lens, meaning that the companies and shares they're looking for is that they're looking for companies that are going to grow over the longer term. They're not too worried about chasing fads, so to speak. So they're looking at things that are got potential over a longer term. There, paying some good franking credits and dividends, and with good growth over time. Whereas Argo, it's been around also a very long time. Look at there's 96,000 investors. They've got $7 billion in this thing, so it's not small. That's for sure. But what they are really doing, the bulk of their revenue is generated primarily, from dividends and distribution. So they're looking for companies that are indeed doing very, very well on paying out on dividends and franking credits and so forth. So they're more focused on the income that it generates, more so perhaps than the growth side of the equation. They're not particularly perturbed about finding something that's, they just want something that has been around for a while, paying good dividends, regular dividends, that will help them grow their money because of all the income coming from all the profits and so forth of those companies. Wilson Asset Management, WAM, obviously far more recent, 1997 there, $5 billion. But what they do here is they look for undervalued companies. So the ones that are a little bit out of favour at the moment, but their value of the company is good, but their share price doesn't reflect it. And so they sort of think, well, okay, if this is a good company, but their share price is cheap, then in theory, the potential for getting back to normal, back to where they belong, is probably pretty good. They've got about 8, this Capital Limited, WAM, actually got about 8 different LICs, where WAM Capital is probably the biggest that's there. But look, it's an interesting concept where they're looking for undervalued companies. MCP, Master Income Trust, very new one in the regard that it started in about 2017 there. But it's really a totally different way of what they're looking at, how they actually, what they're doing there, because they're specialising in fixed income. They're looking at private credit, so it's a bit like a bank. Effectively what they're doing is they're looking at the corporate loans and these sorts of things. So it's effectively a company that is focusing on these types of companies and so forth. So a bit different than your normal, bit different obviously to things like AFI and so forth. So as I say, it's a case of doing your homework. They're not all the same. Their share price obviously goes up and down as the underlying companies that they've bought goes up and down and so forth. It's not for everybody, but it can be. It used to be a very, very popular way for people to get into the market by buying a company that just buys companies. But when we talk tomorrow or the next few days a bit on ETFs, this is also a newer way and possibly these days a little bit more popular. But anyway, there's more things to learn, obviously. So we'll do that in future sessions. Thanks for joining me.